This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the JDfn Forex Report.
Good afternoon, traders. On FOREX Report, we are wrapping up the week on Friday, November 14th, 2008. Well, we certainly didn't end the week with the big bang we were hoping for. The final 48 hours of trading has been plagued with consolidation in many of the majors and crosses. The first few days of the week consisted of much of the same trends we've become accustomed to in recent months. U.S. stocks fell sharply, commodities followed suit, and the high-yielding currencies suffered more losses to the dollar and yen. This should come at no surprise to those of us who stay current with the economic data and developments in the global economy. Early in the week, we saw evidence that Germany was officially in recession, and today it was announced that the Eurozone as a whole is as well. U.S. data this week was worse than last, which seems to be a trend that may last for some time. Weekly jobless claims spiked through the 500,000 level that we could only hope would hold as a ceiling. Last week, 516,000 people in the United States applied for the first time unemployment benefits, while another 3.7 million applied for continuing benefits. These statistics are undoubtedly indicative of recession and will likely get worse before they get better. Today's retail sales report confirmed that the backbone of the U.S. economy, consumer spending, is dropping off a cliff. Retail sales fell nearly 3% last month, the biggest decline on record. Those with cash are cutting back spending, while those who have little money either can't get credit cards, have no room left on their credit cards, or are simply unwilling to use them. Regardless of the true forces, the road ahead still looks grim. Now to the big picture. We've seen more and more central bank heads, government officials, and other high-profile figures in the news as the global economy continues to weaken. A meeting of the 20 largest industrialized nations, the G20, will take place this weekend to discuss a great number of issues. Leaders will brainstorm on what must be done now to stop the bleeding and what measures will be taken to help avoid future crisis. Regulation and tax rules will top the list of reform for the future. Meanwhile, markets are still digesting news from Hank Paulson this week that the Treasury will not be using the $700 billion it received from the government last month for its original purpose of buying deflated mortgage-backed securities. This only added to uncertainties and made free market advocates angry. No matter how the money is ultimately used, it is clear that it will take a while to help buoy this economy. Meanwhile, other economies such as China and Russia are spending billions of their own to stimulate their economies. The threat this poses to the United States is this spending will cut into the money that could be, and often is, used to buy government bonds. We can't help but wonder what this means for the dollar. Of course, this is definitely a bigger picture concern, as traders now are too focused on the credit crunch and economic contraction. Till next week, have a great weekend. Take care.